Welcome to Lecture 5 of Financial Statement Analysis, Part E, Other Ratio Analysis. We've already talked about advanced DuPont analysis and breaking the return on equity into the operating profit margin, operating asset turnover, and then our financing activities, the financial leverage times spread. However, there are other important ratios that help us understand the business's performance. Liquidity analysis is a good starting point. In accounting, liquidity refers to how quickly you can turn your assets into cash. And understanding if your business is going to be able to pay back their current liabilities in the next 12 months is an important place to start with liquidity analysis. There are many ratios that we can look at for liquidity ratios, and some of these you'll already be familiar with. For example, the current ratio, quick ratio, and cash ratio are all measures looking at if we can pay back our current liabilities based on some of our current asset balances. Here are the ratios. The current ratio is the current assets divided by the current liabilities. The quick ratio has many different ways of calculating it. Most of the quick ratio methods look at current assets without inventory and without prepaid assets divided by your current liabilities. The cash ratio is focusing purely on do you have enough cash to pay your current liabilities? And another slightly different one is the operating cash flow ratio, which looks at your operating cash flows from your cash flow statement and you divide through by your current liabilities. These are all measures that are going to try and give you an idea of if your business is likely to be insolvent. We want to make sure we can pay our short-term debts when they fall due, and making sure we have either the cash flow or the current asset base to turn into cash to pay off those debts as they fall due is really important. There are often lots of rules of thumb given for the current ratio. A very simple starting point would be having a ratio higher than 1 is a good starting point. However, when we do valuation, we have to consider both pros and cons of every decision a company makes. If your current ratio is really, really high, like Apple have over $100 billion in cash. Some investors think this is not so good. Yes, it's safe, it's low risk, but it also may lower our returns because it's indicating the assets are not invested in productive capacity. So we do liquidity analysis, we calculate some of these ratios, we try and figure out if it's likely the company will pay back their short-term debts. If the current ratio or quick ratio are very high, well over 1, then it shows the company is safer. But risk and return always trade off together, so it's always worth keeping that in mind. We also have to look at solvency ratios. So when we did our DuPont analysis, we looked at the financial leverage. That's a great starting point to look at the financing decisions of the business. However, there are other solvency ratios that are worth looking at. The liabilities to equity ratio, taking your total liabilities divided by shareholders' equity, is also important. This is taking into account our operating liabilities as well as our financing liabilities divided by our equity. So a little bit different to the financial leverage ratio we've already calculated. Then the key thing we want to look at here is, will the business be able to pay back the interest they have on their loans? And will they be able to pay the principal amounts back on the loans? So, interest coverage ratios based on either earnings or cash flows are good ways of looking at if we can pay back our interest on our loans. Instead of just doing net profit divided by interest, we use a measure of performance called EBIT, which is earnings before interest and tax. So that is the net income plus the interest expense plus the tax expense. That's the amount of earnings the business has before they've actually made the interest repayment. So it's the ability to make the interest repayment before the interest repayment's removed from profit and before any tax, which is impacted based on the interest as well. So EBIT, earnings before interest and tax, divided by interest expense, gives you the interest coverage ratio. Because we know accrual accounting and our net profit can be different from our cash flows, we can also do this using our cash flow from operations, plus interest plus taxes paid divided by, that's also another way of getting at this ratio. The key for solvency analysis, will we be able to pay our interest back? Then we want to look at the notes to the financial statements and also see when our debt will be due. If we have bonds, for example, that are due in 2 years, do you think it's likely the business will be able to make that principal repayment in 2 years, or will they be able to re-borrow again? That kind of analysis is going to be important looking at interest and principal repayments. It's very important to analyze the cash flow statement as well. Although we didn't have to reformat the cash flow statement does provide lots of very useful and helpful information in analyzing the business. We need to look at all 3 sections of the cash flow statement. We need to get an idea of if we think the operating activities are generating strong cash flow. This gives us a good idea of if the business is actually able to generate cash as well as any earnings it's got in its profit and loss statement as well. We need to look at the investing activities of the firm to look at if they're investing in future growth potential. Are they buying new assets? Are they building new stores or expanding their operations generally? This will be a good idea if we want to improve our growth in the future. We need to make investments today to fund growth in the future. And the financing activities, do we think the business is going to need to borrow more money or raise more money from its shareholders? Or is it currently paying back debt and paying out dividends to its shareholders? What are the current financing arrangements? Because that will influence our likely financial leverage ratios in the future, as well as our interest rates in the future as well. So all this information will help us with understanding our ratios and how they've changed, as well as what they'll do in the future. So overall, there are a range of different other ratios that we can calculate in addition to the DuPont analysis. Please think about these ratios. When you do your assignment, we don't want to just see pages of ratios. We want to see you present stories about the interesting ratios and understand what's driven the changes in the ratios. Look at the ratios that are really important for your business and try and find ones that are actually meaningful. That allows you to get good insights which will help your forecasting in the future. We're starting to finish up our discussion of ratios. So what are some common mistakes that students make? When you calculate your return on equity, whether you calculate it as net profit over average equity or you use the advanced DuPont formula, you should get the same return on equity calculation answer. They both have to equal each other. So if it doesn't equal, one of the most common mistakes is either you've made a mistake in your reformatting or you've used comprehensive income instead of net income. Okay? Because we've reformatted and we've calculated NOPAT and net financial expense after tax without the other comprehensive income, we need to use the net profit figures for these calculations. You need to show that both your return on equity figures match each other in your assignment. It helps to show that you haven't made any obvious mistakes in your reformatting. In conclusion, calculating the ratios is something that's very important for us to be able to do, but you're not going to get paid the big bucks just for being able to do the calculations. Computers can do it. We can look at databases and find some of the ratios, although not often broken into the operating and financing activities like we need to do. However, the key skill and what we'll be looking for in your assignment is if you can actually link the ratios to what's actually happening in the business. Don't just tell me the profit margin went up and down and up and down. Think about what the managers did, what the employees did, what was happening in the industry and competitors that changed the profit margins. Once you actually start explaining changes in the ratios based on changes in the business operations, then that's where we can actually start to get some insight and be able to gain some ability to predict the future. By doing the ratio analysis carefully, it should help you by making sure you understand the industry, economic, and strategy analysis in more detail. You've already put a lot of effort into understanding those factors of your business. When you then calculate the ratios, you'll be able to double check if you are seeing the same patterns in the firm's finances as you expected would have happened. For example, if you discussed that your company had a very close relationship between GDP and their sales, now when you go and look at their sales growth, you can compare that to the GDP and you should see a constant relationship. If you were discussing that the industry profitability is going to decrease in the future because competition has increased, you should see decreases in profit margins. The ratios will be linked to your economic, industry, and strategy analysis that you've already done. So this week we've concluded with understanding the past of the company. We've finished step 1 and step 2 in our business analysis framework. Next week, we're going to start thinking about the future, forecasting future performance based on what we know of the past. And that will then allow us to start doing some valuation models in future weeks. Thank you very much. And I'll have a demonstration video looking at calculating the ratios in Excel for you as well. And the following slides will also have a little calculation example in here as well. Thank you very much.